So, Alexandra, let's start with your reflections on 2024 as we approach the end of the first quarter.
Well, good afternoon, Ole, Christian. I will try to give you a short overview of the recent movements and set them somewhat in perspective of the market going forward. Now, we've had a good start to the year for the stock markets globally. The MSCI All Countries World Index is up 6% in US dollars and up 11% in Norwegian crowns. Since the start of the last year, the MSCI All Countries World Index is up over 40% in Norwegian crowns and they're over 30% in US dollars. Equities have had strong momentum since the October 2023 sell-off, particularly in the US, with the S&P 500 up 24%, and it hasn't once fallen by as much as 2%, and this is its longest such streak in 6 years. Now, market rally is also broad-based, not just the Mag 7. Over 80% of the US S&P 1500 stocks have generated positive returns since the October low, and this is good news for stock pickers. And on a sector basis, the strength of technology and communication services has endured, up 8 to 10%, while real estate and energy has continued to be weak. And renewable energy, it has been particularly disappointing, down 14%. And many of the things that we saw in 2023 have continued into 2024. Growth has outperformed value by 5%. Large caps have outperformed small caps by 5%, and developed markets have outperformed emerging markets by 5%. All these numbers are in US dollars. And many country indices have also hit all-time highs in recent weeks, listing up the S&P 500, the Nasdaq Composite, Japan's Nikkei 225, and the Germany's DAX and France's CAC 40. Positive momentum and breadth of gains extends beyond the US. Now, closer to home in Norway, we've had an 8% fall in the equity market. It's been weak so far this year, while Denmark has been among the big winners, up 16%, driven by the pharmaceutical company Novo Nordisk, and is also at an all-time high. And if we go further afield, China is up 4% and has stabilized, and India is continue its run with up 4% as well, while the commodity-heavy Brazil index has been equal to the Norwegian commodity-heavy index, down 9%. And again, it's all in US dollars.
Thank you, Alexandra. So that was the overall picture, if you like. Let's talk about Skagen's funds.
All right. Well, all of our funds except one, that's Skagen M2, have generated positive absolute returns so far this year. On a relative basis, our two largest funds, Skagen Global and Skagen Kontiki, are ahead of benchmark, while our three smaller funds are lagging. But we've still got a long way to go this year. And more important for clients, I believe, is the longer term picture, and here we continue to do well. 4 out of 5 funds are beating the index over 3 years, and 3 are ahead over 5 years, which is our recommended minimum investment horizon. And we've also picked up an award in Germany for Skagen Global being the best fund in its category over 20 years. And we have also picked up some others that we cannot tell you about yet. But I will say that we've had a very satisfactory start to 2024.
Now, when we spoke in December, Alexandra, we were in the midst of the everything rally. What's the current mood among investors?
Well, short, it's very strong. Investor sentiment is increasingly positive and looks very different now to a year ago. when we had the Sunnyvale Bank, which had just collapsed. There are some areas of the market, like real estate and renewable energy, which continue to face challenges, but overall investors are generally very bullish, according to the latest surveys. The February Bank of America Global Fund Manager Survey showed sentiment among institutional investors to be its most bullish since January 2022. And this has continued to the March Global Fund Manager Survey as well. And if you look at retail investors, they are similarly positive. The American Association of Individual Investors surveys a bull-bear spread, which is the percent of respondents saying they are bullish on stock minus the percentage saying they are bearish. This has broken through the top decile of historical optimism. And of course, more telling is that fund flows have also been positive. Global equity funds have received 84 billion over the last 6 weeks, a 2-year record, and emerging market funds also saw record weekly inflows at the start of February. And another sign that we are in a risk-on environment could be that Bitcoin is up over 50% this year alone and recently hit an all-time high of $72,000. And I'll let you decide whether that offers good value or not.
What in your mind is driving this positive sentiment?
I think there are two main drivers. One is the improving economic outlook, and the other is our strong company earnings. If you look at the first one, the global economy is still strong. Inflation continues to fall, albeit more slowly than many predicted or would like, and interest rate cuts are visible on the horizon. And more importantly, that GDP growth remains largely positive, and the consensus among economists and investors is that we will achieve a soft landing and avoid recession. This has helped the second driver of positive sentiment, which is that company earnings also remain solid and expected to grow. The S&P 500 companies beat earnings expectations by an average of 7% in the fourth quarter, according to JP Morgan, and albeit the bar was fairly low after several estimate downgrades. But looking ahead, the US earnings are expected to grow 10% this year, which is 4 times higher than 2023, and all regions are expected to see significant earnings expansion. Even double-digit growth in emerging markets and China, helped by continued economic growth, lower inflation, and lower interest rates. Though if you dig a bit deeper, you will see that the technology sector, and particularly the Magnificent Seven, are expected to continue to do most of the heavy lifting. The Nasdaq 100 is expected to grow earnings by 40% in 2024. And Mag 7 is expected to grow EPS by 30% in 2024 versus 8% for the rest of the S&P 500 index, which is still a healthy growth rate. And this is fine as long as they continue to grow. Now, NVIDIA recently announced year-on-year revenue and earnings growth of 265% and 585% respectively. But the question, of course, is how long this will last and what happens when the music stops.
So let's circle back to Skagen then. Where are you seeing opportunities for our portfolio managers?
Well, the outlook for the world economy is good. Earnings are growing. So the question is, what are we paying for these earnings? And if we start by looking at valuations, markets generally look to be fully priced. Now, developed markets are trading above historic averages with the MSCI World Forward price earnings ratio of 18 times versus 16 times on average, historical average. Although this is, of course, skewed by the US, which has a weight of 70% of the world index. which is trading at a much higher multiple, actually at the higher end of its historic range, at a price-earnings ratio of 21 times earnings. The US continues to get more expensive relative to both emerging markets, notably China, which is now at a 60% discount to the US, and Europe, which is at a 30% discount to the US. So this means that on valuation grounds, most opportunities are outside US, apart from sectors like property, where US commercial real estate is distressed. Emerging markets and China are cheap relative to both history and their own history. So let me just say a few words on China and South Korea. China, we see signs of stabilization. The Chinese government recently taking measures to support stock markets, the cutting of the bank reserve limits to boost lending, tightening short selling rules, and proposing a $278 billion rescue package to stabilize the equity markets. Current Chinese equity risk premium, now at around 10%, has only previously been this high during the 2008 global financial crisis. And we have seen in the past, when we've had such high equity risk premiums, that the 12-month following equity returns have been positive. The year-to-date Shanghai Composite is up 4%, and the MSCI China Index is up 3%. So there are signs of recovery. Now moving on to South Korea, and the government initiative called the Value Up program, which was launched in January this year to tackle the persistent Korea discount. Now, the Value Up program is very similar to the Japanese approach, posing questions such as to the boards of the companies: why is your company lowly valued? What are you going to do to change this, and communicate your plans to investors? This is important because historically, the government has encouraged Korean banks to build capital, excessive capital, some might say. So why now? Well, partly because more people care now. The elections are coming up in April, and more Koreans own stocks. Now more than 14 million investors, more than double only 4 years ago. And with the aging population in Korea, pensioners need to see the value of their pensions increase to fill the pension gap. So the Value Up program, if approved, will follow the success of similar initiative in Japan, and positive signs are already seen in South Korea, with strong equity performance since launch of the program in January, with the KOSPI up 10% and the MSCI Korea Index up 16%. Now, we've also supported activist pressure. We have supported Aligned Partners campaign against Korean banks. The KCGF linking low valuations to low returns on savings and weak capital raising opportunities shows that these absurd valuations have a negative impact on long-term competitiveness. And these public statements are supported, like I said, by activist investors such as Aligned Partners, whom we have supported to increase shareholder returns at Korean banks. Now, I think this also shows, you can see here to the right here, a letter we have written to some of our holdings. So this shows active ownership in practice, meeting our companies, meeting with other investors, and working to improve governance and returns. And I recently went to Korea with head of ESG, Sondre Myge, to continue the dialogue on behalf of our funds invested in Korea. Now we can also look at the valuation of small and mid caps. We have a valuation discount here, where the large mega caps remain at a record level, and we see that the small caps are traded at a huge discount, maybe only the EM, the emerging market small caps, are an exception to this slide here. And I can recommend the excellent presentation that my colleague Jonas Edholm of Skagen Focus gave at our New Year's conference back in January, Mind the Gap, which outlined the small cap opportunity and is available on the Skagen website. And I really recommend it warmly.
Okay, so that were the sort of the opportunities or the positive sides that you see right now. But what about risks?
Well, I'd like to mention 3 risks. That's concentration risk, economic risk, and geopolitical risk. Now, going first to concentration risk, the dominance of the biggest companies means that the markets are becoming increasingly concentrated in most regions. The top 10 largest companies in the global index, the MSCI All Countries World Index, now make up nearly 20% of the benchmark. And in the US, the top 10 companies now accounts for 30% of the S&P 500, more than the dot-com bubble, and now at its highest since 1980. And what I'm showing here is a valuation of the 10 largest stocks in the S&P 500, double the price of the rest of the S&P 500. Now, concentration in equity markets is also rising in other ways, other than the size of the companies. But it's also, if you look at the US share of the global equity market, it has steadily grown since the great financial crisis. Now, 70% of the global MSCI All Countries Index is in the United States. And of course, we all know that at a sector level, the weight of technology is the highest in the US and also in Asia since the dot-com bubble. Now, all of the above also is a risk for passive investors in US, developed markets, global index funds, given the potential for mean reversion. Now, it's likely to be accelerated when large cap US tech earnings disappoint, which will happen at some stage. We've seen also recent signs that are maybe signs of cracks. We have seen the largest weekly outflow of tech funds recorded this month. And we've also seen that Mag 7 insiders are selling shares at the fastest rate since 2021. And moving on to the second risk I mentioned, the economic risk that's connected to inflation, interest rates, and recession fears. Looking at inflation, the February US inflation was above expectations for the second consecutive month, with services, largely housing, inflation particularly sticky. Yet stock markets did largely shrug this off because it does show that the economy is very strong and can deal with it. And then you have the interest rates. Because of the sticky inflation, investors have been pushing back the expected start of the rate cuts since the start of 2024. Now, according to Bloomberg, the world interest rate probabilities now indicate 3 US cuts by the year end, with the first happening in June or even pushed back to the second half. So there's a Fed meeting tomorrow on the 20th of March where there is a very high probability that rates will remain unchanged. But I think investors will be watching very closely for any signals that the current expected path may change. So maybe likely to be just more disappointed than positively surprised, but we will see. Any change in consensus and guidance, realization that rates destined to remain higher for longer, could negatively impact stock markets, given the reduction of 75 basis points in 2024 is largely priced in and unchanged by the February inflation reading or CPI reading. And of course, this has impact. This will impact growth. I mean, the risk of a hard landing if rates stay higher for longer and cause economic activity to fall and unemployment to rise. And this is particularly stressful among lower income brackets where sticky inflation hits hardest, and you will be stressed further if interest rates stay higher for longer. The US Consumer Confidence Index also unexpectedly fell in February and missed expectations of an increase versus January. And the third and final political risk that I would like to share with you today is, of course, the geopolitical risks. It is cited as the second biggest risk according to February Bank of America Fund Manager Survey. We can mention the US-China tensions. We can mention the ongoing conflicts in the Middle East with the conflict in Gaza and the Red Sea shipping attacks, and the possibility that tensions will spread wider in the region. And then finally, closer to home, we have Russia-Ukraine. There is no side to the war with Ukraine. But we also saw last couple of months Sweden following Finland in joining NATO in February.
Okay, now to something a bit more nice, I suppose. Portfolio managers in Skagen are quite frequent travelers to our different portfolio companies. And you recently returned from Asia. What are your reflections from that trip?
Yeah, we regularly go visit our holdings. We visit think tanks. We visit other investors, etc. And a couple of weeks ago, our head of ESG, Sondre Myhre, and I went on a trip to Asia. Our goal was to focus on ESG and learn as much as possible. Now, in addition to clearly communicating our expectations to our fund holdings and what we believe will create shareholder value, these trips are important to build knowledge and share across the department so that we all understand different cultures, politics, economics, and much, much more that is necessary in order to make the right investment decisions around the globe. Now, in Korea, we met with many of our holdings, 7 in total, and we focused the main part of our discussions on the value up program. We then went on to Vietnam, where we learned about how the country's one-party government is able to navigate between the two superpowers, US and China. We learned about the gradual opening of the country for the successful, I would add, gradual opening of the country to foreign investments, and the really, really general optimistic attitude regarding future growth for the people. We met with 5 different companies and macroeconomists, etc. in Vietnam. And then the last place we went to was to India. We spent a day with UPL, the world's largest plant protection company. It's a holding in our emerging market fund, Skagen Kontiki. And a nice anecdote from their innovation pipeline is a 100% natural product that can absorb 50 times its weight in water and can hold it for up to 6 months, being a store of water in the soil for plants to survive dry seasons. So that was an optimistic end. And here is a picture of us with the management of UPL, where we were also invited to plant a tree each in Gujarat in India.
Very exotic indeed. Now, for the $100 question, how do you expect the remainder of the 2024 to unfold?
Well, it will certainly be quite exciting. I think cheap valuations in pockets of the global equity markets and structural reform initiatives in places like South Korea and China suggest we could see a rebalancing away from US tech and growth and towards emerging markets and value. We're also seeing, of course, the start of a longer-term shift in friendshoring, nearshoring, especially towards the United States. And here we also see opportunities for stock picking of the right companies with attractive earnings opportunities. And of course, this favors active price-driven approach with the benefit of having broad mandates to be able to navigate where we see the opportunities. However, there is also a decent chance of a market correction, given strong recent momentum and fragility of support based on the factors above. Complacency that 2024 rate cuts nailed on, valuations and earnings expectations that leave little room for disappointment, high concentration risk, and a very, very bullish investor sentiment. So likely to see the biggest falls in areas that have gained the most, like US tech and AI-related names. The issue then, of course, is how much of the market is brought down with it and how far does it fall. But the best protection in our minds is diversification, low valuation, active stock selection to minimize downside risk. Of course, the cost could be giving up some short-term gains of if AI-driven rally continues, but it's worth it long-term. Try to stay invested and sleep easy.